If you're like most Americans who are currently faced with the challenge of making a life, having a little extra money once in a while to spend it on the things that they enjoy, and having to save for retirement along the way, but finding out that you have the largest bill in the world, which is taxes, right? If that is you, this video is for you. Hi, my name is Mia Taylor. I'm an enrolled agent and a tax advisor and your host for today's tax tip. Now, in today's tax tip, I will be sharing how taxpayers are using retirement accounts to save in taxes. That's right. But before we dive into today's tax tip, please be sure to hit the notification bell, like, share, and subscribe to our page to make more tax tips like these. So also be sure to stay till the end of this video, as I will be sharing a bonus tax strategy regarding retirement. So without further ado, let's get started. Pre-tax, tax-deductible, and tax-free benefits have been a game changer for many taxpayers who figured out how to take advantage of this space within the tax code. Retirement is the most overlooked strategy regarding tax savings. You see, there are 3 ways to save in taxes with retirement accounts, and that is 1, pre-tax contributions, 2, tax-deductible contributions, and 3, tax-free growth and withdrawals from a retirement account. Today, I'm only going to be covering 2 types of retirement accounts so that you have a better understanding of how these savings are generated. But first, let's define what a retirement account is. See, a retirement account is known as an individual account, and that individual account is a tax advantage account that allows taxpayers to fund their retirement with pre-tax or after-tax income to use for retirement when they reach the age of 59.5 years old. There are 2 types of individual retirement accounts, okay? The first kind is the traditional IRA account. The taxpayer owns this account. You as a taxpayer can fund up to $7,000 for the tax year of 2024 and take a full deduction of the $7,000 as long as you are meeting the following modified adjusted gross income thresholds. Now, before we get into the income threshold, allow me to define modified adjusted gross income. Modified adjusted gross income is all of your income reported on your 1040 plus exempt and excluded income and certain deductions that is added back to your income reported. So for example, items added back to make up your modified adjusted gross income would be the following. 1, it would be student loan deductions. That'd be added back. Rental losses, added back. Passive losses and passive income, added back. Half of your self-employment tax deduction, that'd be added back. And if you're collecting Social Security income, the non-taxable portion of that amount would be added back to make up your modified adjusted gross income. Now, getting back to the income thresholds in order to get the full IRA contribution deduction for the $7,000. So, if you and your spouse are currently participating in an employer's retirement plan, then your full deduction is granted as long as your modified adjusted gross income does not exceed $77,000 single or $123,000 married. Your deduction begins to phase out when your modified adjusted gross income exceeds the $77,000 or $87,000 married filing joint, in between $123,000 to $143,000 married filing joint. Okay, now for people who are filing married filing separately, that deduction is completely phased out when your income hits $10,000. Now, the second threshold is if you or your spouse are currently participating in an employer's retirement plan, then your full deduction is granted when your modified adjusted gross income is below $230,000. Now, once your income exceeds the $200,000 and up to $240,000, your deduction will phase out to 0. If neither of you or your spouse participate in an employer retirement plan, then all of the $7,000 contributed to the IRA is fully deductible. The only drawback from using the traditional IRA account is that this account has age restrictions. See, this account prohibits taxpayers who've reached the age of 65 years or older to no longer be allowed to contribute to their traditional IRA account. This account also mandates that taxpayers who've reached the age of 72 years of age are required to now take mandatory distributions from the traditional IRA accounts, or else pay a hefty 40% tax bill based off the value of your IRA. Ouch. The second type of IRA account is known as the Roth IRA account. The Roth IRA account is an individually owned account, and this account has special benefits that allow the taxpayer to fund their retirement up to $7,000 for the tax year 2024 tax-free. Now, the Roth IRA grows tax-free. When you turn 59 years half, you can withdraw it tax-free. Another bonus for having the Roth IRA account is that there's no age limits to contributing to this account. Neither is there any mandatory distributions that you have to take. Now, to fund your Roth IRA account, you must meet certain income thresholds, and that is your modified adjusted gross income cannot exceed $146,000 if single or $230,000 if married to fully get the contributions into that account. Otherwise, it begins to diminish as your income begins to climb between $146,000 to $161,000 for single or $230,000 to $240,000 married. Once your income reaches the top of these thresholds, you are no longer able to participate in the Roth IRA strategy. And if you contribute to the Roth with income in excess of the thresholds that we talked about, you will be charged an additional tax from dear old Uncle Sam. So, how do we get around the restrictions that has stopped millions of Americans who have income that is above $230,000 to be able to participate in this tax-free retirement account? Well, the strategy is known as the backdoor Roth strategy. See, essentially, you make non-deductible contributions from your traditional IRA account, and you later transfer or convert your contributions into your Roth IRA account. That's how you get the money in. Now, if you'd like to see more tax tip videos like this, support this channel by clicking the button below, subscribing to our page to receive more tax tips like these. You can also visit our website for tax blog articles that covers healthcare strategies, retirement strategies, hiring your children, gifting strategies for family. Also, if you have questions about this video that you just watched and you want to know how these strategies will work for you, contact our office and one of my teammates will gladly assist you. In the meantime, we will see you next time. Thanks.